Welcome back to Wealth Signal. I'm Alex Carter, and what I'm about to share with you today might be the most important financial framework you've ever heard. Stay with me to the end. The system doesn't fail the poor. It works exactly as designed. That's not my opinion. That's the conclusion you reach when you actually study how wealth moves, who captures it, who loses it, and why the same patterns repeat generation after generation. Warren Buffett has spent over 7 decades at the intersection of economics, psychology, and human behavior. And what his career and his philosophy reveal is something most financial education will never teach you. Not because it's secret, but because there's a silence, a curriculum gap, between how wealthy families think about money and what the rest of the world is taught. Today, I'm going to close that gap. We're going through 8 structural truths about how money actually works. Not motivation, not theory, real frameworks, the kind that change how you think permanently. Let's begin.
There's a tax that nobody tells you about. It doesn't appear on your pay stub. The government didn't pass legislation creating it, but it takes more from you than almost any other financial force in existence. Buffett's framework for understanding poverty has always started with a simple observation. Being poor is expensive, not just emotionally, mathematically. Think about how a wealthy person buys a winter coat. Once, high quality, it lasts 20 years. Now think about someone who can only afford the cheap version. It falls apart in 1 season. They buy it again, and again. Over 20 years, they've spent 3 times as much money, and been cold half the time. This principle scales to every corner of life. The car that breaks down, the apartment without insulation, the payday loan that costs 300% annually. Every single purchase becomes more expensive when you start from less. But here's the part that makes this truly devastating. It's not just the money, it's the cognitive cost. Research out of Harvard found that severe financial stress consumes so much mental bandwidth that it creates a measurable drop in cognitive function, the equivalent of losing 13 IQ points, the equivalent of going a full night without sleep. The person who can least afford to make financial mistakes is making them with a brain operating at a significant cognitive deficit. They're solving a harder problem with less capacity. So what's Buffett's answer to this? It's not glamorous. Build a buffer. Not wealth, not investments yet. A small, untouchable emergency reserve. For some people, that's $500. For others, it's $1,000. The specific number matters less than the principle. You need a small pond between you and the next disaster, so that the next car repair or medical bill is an inconvenience, not a catastrophe. When that buffer exists, the survival panic quiets. The time horizon extends. You stop reacting and start planning. And planning is where everything begins.
If this is already shifting how you think about money, do me a quick favor. Hit that like button and subscribe. We release one deep dive like this every week. Now, let's talk about why working harder is often the wrong strategy entirely.
Go to any coal mine in the world. The people working there are working harder than almost anyone. Their effort is enormous. Their output is physical and real. And yet, they're paid a fraction of what a software engineer earns. Someone who might spend 6 months writing a program that then runs on 20 million devices without requiring their presence at all. This is what Buffett has called one of the most misunderstood dynamics in personal finance. The market does not compensate effort. The market compensates scarcity combined with leverage. If you can be replaced by anyone willing to do the same job for the same price, you will always be paid the minimum the market requires to keep you from leaving. The poor are taught to work hard within systems designed to keep them replaceable. They specialize in common skills. They take standardized roles. They are made interchangeable, and the market prices them accordingly. The wealthy are taught something different.
They're taught to build what economists call a moat, a combination of skills that is rare and difficult to replicate. Buffett applies this logic to businesses constantly. He doesn't just ask, is this company profitable? He asks, does this company have an advantage that's hard to take away? That's the moat. And the same principle applies to individuals. Think about this. A graphic designer with 10 years of experience is valuable, but there are tens of thousands of them. The market pays them accordingly. But a graphic designer who also understands consumer psychology and financial metrics and can write copy that converts is almost impossible to replace. They're not one skill, they're a stack. The intersection of rare skills is where the market pays a premium. That's where your income begins to decouple from your hours. And when income decouples from hours, everything changes. Buffett tells a story, not literally, but through his behavior, that every serious investor needs to understand. Two people, same neighborhood, same starting salary. 5 years later, one of them drives a new car, designer clothes, 2 vacations a year. The photos look like success. The other one drives a 10-year-old sedan, simple apartment, no visible wins. 10 years in, the first person has a net worth of essentially zero. Negative, actually, because of the loans taken to maintain the appearance. The second person has quietly built a growing investment portfolio. Not rich yet, but building towards something real. What Buffett has always argued is this: there is a critical difference between assets and liabilities that most people never learn to see clearly. An asset puts money into your pocket while you sleep. A liability takes money out of your pocket while you sleep. That new car loses value the moment you drive it off the lot. It requires insurance, maintenance, fuel. It's a liability wearing a costume of success. A share in a productive business earns revenue while you do nothing. It compounds while you sleep. Every dollar it earns can buy more shares, which earn more revenue. The real danger, and this is what Buffett understood early, isn't that people knowingly buy liabilities. It's that they buy them to feel wealthy. They're purchasing the emotion of success rather than the structure of it. The dopamine hit from buying something beautiful is real and immediate. The dopamine hit from adding $100 to an index fund is almost non-existent. You can't feel compound interest. You can't photograph it. But in 20 years, the person who chose compound interest over consumer goods will own something the other person cannot buy back. They will own time. They will own options. They will own the ability to say no. If you're getting value from this, share it with one person who needs to hear it. That's genuinely the best way to support this channel. Let's keep going. The next one is about inflation, and it's one most people get completely backwards. Most people understand inflation as a consumer problem. Prices go up. Groceries cost more. Everything is a little more expensive every year. That's the surface. That's what gets taught. What doesn't get taught is the mechanism underneath, and it's one of the most important things to understand about how wealth actually distributes, or fails to, in any modern economy. Here's what actually happens when the money supply expands. New currency doesn't distribute equally to everyone at the same moment. It enters through specific channels: banks, asset markets. Asset prices move first. Stocks go up. Real estate goes up. Business valuations go up. The people who already own those assets see their net worth increase immediately. They capture the inflation before it reaches the streets. Then, with a delay of months or sometimes years, consumer prices rise. The things working people spend most of their income on: groceries, utilities, rent. And last, wages adjust. Because wages are what economists call sticky. Employers don't raise them automatically. By the time the worker receives a 3% raise,
inflation has already eroded 7 or 8% of their purchasing power. Buffett has described this dynamic directly. He's pointed out that the best protection against inflation isn't cash. It's ownership of businesses with pricing power, companies that can raise their prices alongside inflation, or ahead of it. The structural conclusion is clear. Every time the money supply expands, wealth is quietly transferred from people who hold wages and cash to people who hold assets. The inflation engine runs continuously, and it runs against people who have nothing to put in front of it. The answer? Move as quickly as you can from being someone who holds cash to being someone who holds ownership. The asset doesn't need to be glamorous. A low-cost index fund that tracks the broad market is sufficient. It participates in the repricing of productive businesses. It captures inflation as it rises, rather than suffering from it. People hear the phrase compound interest and they nod. They think they understand it. They don't. Because if the full weight of it actually landed, if it became real in their bones, they would behave completely differently. The formula for compound growth has 3 variables: principal, rate of return, and time. Most people focus obsessively on the first 2. They want to start with more money. They want higher-yielding investments. They argue about which fund, which stock, which strategy is best. And they almost completely ignore time. Here's why that's a catastrophic mistake. Time is not just one of the 3 variables. Time is the exponent. It doesn't add to the formula, it multiplies it, exponentially. Buffett started investing seriously at 11 years old. By the time he reached 50, he had 40 years of compounding running. And then, in the following decades, that base exploded into something that would have seemed impossible to describe earlier in his life. That's not genius. That's not some brilliant stock pick. That's the exponent of time applied to a base that was given long enough to run. Here's the practical consequence. If you start investing a small amount today and let it compound for 30 years, the result is extraordinary. If you wait 10 years to start, even if you invest more aggressively, you end up with a fraction of what the early starter accumulated. You cannot buy back the early years. No rate of return compensates for missing the beginning of the curve. There's also a psychological dimension that almost nobody talks about. Compounding is invisible for a long time. The curve is flat for years. You invest month after month, and the number grows almost imperceptibly. Most people can't survive the flat part of the curve. They get bored, they get impatient, they interrupt the compound process, and the magic evaporates. The discipline required is not financial, it's psychological. It's the ability to trust a mathematical process you cannot see or feel, to look ordinary now in exchange for something extraordinary later. Plant the tree. Give it time. Drop a comment right now. Which of these 5 secrets hit hardest for you? I read every single comment. Let's keep going. 3 more, and they build on each other. Buffett has said publicly, on multiple occasions, that his secretary pays a higher effective tax rate than he does. He's said it directly. And every time, it makes people uncomfortable. Because they don't understand why it's true. The tax code in virtually every major economy creates 2 distinct categories of income. The first is earned income. The money you receive for your labor, wages, salaries. The government taxes this at the highest available rates before it even reaches your bank account. The second is capital income. Money generated by assets you own, dividends, capital gains. The government taxes this at significantly lower rates, sometimes half the rate applied to labor income. The stated justification is economic theory. Capital formation drives growth, investment creates jobs, so capital should be rewarded more generously than labor. You can agree or disagree with that theory, but it doesn't change the mathematics. If you earn your living by selling your time, the government takes the largest possible percentage of what you earn. If you earn by owning productive assets, it takes a smaller percentage. Buffett's entire approach to wealth building has been to structure income as capital income rather than labor income wherever legally possible. Not through loopholes, through understanding how the system was designed and being on the side it was designed to favor. There's a second layer here. Business owners can deduct a vast range of expenses before calculating taxable income. The car used for business, the office space, the equipment, the professional development. These deductions reduce the taxable base before the government calculates what's owed. An employee has almost none of these options. They receive their gross income, the government subtracts immediately, and what remains is theirs to manage. The poor are taught to file their taxes and pay what they owe. The wealthy are taught to understand the code and structure their affairs within it to minimize extraction and maximize retention. Learn the code. It was written for someone. Make sure that someone is you. Buffett has spoken about this in a way that most people don't hear clearly enough. He's said that he's incredibly lucky to have been surrounded, from early in his career, by people who were operating at a higher level than he was, people whose standards became his standards. Your network is not your net worth because of the favors people can do you. It's your net worth because of who you become when you're surrounded by the right environment. This is biology. Human beings are social creatures with mirror neurons. We subconsciously model our behavior, our vocabulary, our standards, and our expectations on the people we spend the most time with. If your environment is defined by people who normalize financial struggle, who treat ambition as arrogance and wealth as luck, your brain will model that as normal, and you will unconsciously keep your behavior consistent with that norm. There's a phenomenon called the crab bucket effect. Put crabs in a bucket. When one tries to escape, the others pull it back. Not from malice, from instinct, from the drive to maintain the group equilibrium. When you begin to improve financially, when you save instead of spend, when you talk about assets instead of complaints, the people around you will feel the shift, and many of them will resist it because your movement upward makes their stagnation visible. But here's what Buffett's example shows us. You don't need a country club membership to access a different mental environment. You need books. You need the right conversations, even recorded ones. You need to spend time with the thinking of people who have navigated the path you're trying to navigate. When you read deeply about how serious investors think, you're downloading their mental models. You're calibrating your sense of what's normal and what's possible upward. Choose your intellectual environment as carefully as you choose your investments. The compound effect applies to people as powerfully as it applies to money. This is the final secret, and it's the one that ties everything else together. Most people define wealth as a number, an amount of money in an account, a balance sheet figure. And they pursue wealth the way you pursue an object, running toward it, hoping to grab it and hold on to it. This is a broken mental model, and it explains why so many people who receive sudden wealth, lottery winners, inheritance recipients, athletes at the end of their careers, lose it within a few years. The money was never the thing. The thing is the system that generates the money. And a system cannot be received, it can only be built. Buffett's entire career illustrates this. He didn't just pick good stocks. He built a system, Berkshire Hathaway, that generated capital, identified opportunities, allocated resources, and compounded value across decades. The system was the point. Here's the architecture of a personal wealth system, broken into its essential components. First, defense. A buffer account. High-interest debt eliminated. Insurance structure that protects the system from catastrophic loss. Without this, one bad event destroys everything you've built. Second, acquisition. redirecting earned income into productive assets consistently. It begins small. It must begin small. $10 a day into a low-cost index fund is not impressive, but $10 a day for 30 years at historical market returns is genuinely life-changing mathematics. Third, leverage. Not financial leverage, structural leverage. Building something that produces value without requiring your direct, hour-by-hour presence. A skill that scales. A business. Content that earns. If you have one source of income that doesn't require your active involvement, you've introduced leverage. Fourth, protection. As the system grows, it faces threats, taxes, inflation, social pressure, the expectations of people around you who believe your growing wealth should fund their wants, the temptation to upgrade your lifestyle proportionally to your growing income. These are the forces that end more financial ascents than any market crash. And fifth, time. You cannot accelerate this. Each year with the system running is a year of silent, invisible progress that will eventually become impossible to ignore. This is the architecture of real wealth, not luck, not a brilliant pick. A system built deliberately, defended carefully, and given the time it needs to operate.
Let me bring all 8 together before we close. 1. The survival premium punishes the poor by making poverty itself expensive. Break it by building a buffer. 2. The market doesn't pay for effort. It pays for scarcity. Build a rare stack of skills. 3. Stop buying costumes. Start acquiring assets. The difference is whether something puts money into your pocket or takes it out. 4. Inflation is an engine. It enriches owners and impoverishes wage earners. Get on the right side of it. 5. Time is the exponent. Start now. The early years are the most powerful years of the compound curve. 6. The tax code was written for owners, not employees. Learn its structure and position yourself on the side it was designed to favor. 7. Your environment calibrates your brain's sense of normal. Choose your intellectual community as carefully as you choose your investments. 8. Wealth is not a number. It's a system. Build it deliberately. Defend it carefully. Give it time. None of these require luck. None require connections. They require understanding and then action. The information exists. The question is whether you'll act on it. This is not financial advice. Do your own research. Consult a qualified professional before making investment decisions. Investing involves risk, including the possible loss of principal. But what I will say is this: the clock is running. The compound engine requires time, and every year you give it is a year that cannot be retrieved if wasted. 3 things before you go. First, hit that like button. It helps this analysis reach more people who need it. Second, subscribe and hit the bell. We break down one deep framework like this every week. Third, leave a comment. Which of the 8 secrets changes how you think most? I read everything. I'm Alex Carter, and I'll see you in the next one.